So everybody wants to defer tax when they sell real estate. But here's what most people miss. The tax plan actually starts when you buy. Let's say you bought this apartment building for $600,000. You added $200,000 of improvements and you claimed $300,000 of depreciation. Your adjusted basis is now roughly $500,000. Sell the building for $2 million and the projected gain is about $1.5 million. That's before selling costs and other adjustments. Now the CPA needs to model 3 different paths. One is going to be a direct sale, which gives you liquidity, cash directly into your pocket, and a clean exit. But the gain is going to be recognized in the year of the sale. A 1031 exchange may defer eligible gain into the replacement property. You identify the replacement property within 45 days and generally receive it within 180. Cash taken out may be taxable, but you still have your replacement property. A deferred sales trust proposal works differently. Before a binding sale with the final buyer, the property is sold to an independent trust for an installment note. The trust then sells the property to the buyer. The cash stays with the trust. It does not come to you directly. You start receiving payments under the note over time. If the structure of this irrevocable trust is respected, gain may be reported as those payments arrive. In other words, you pay the tax as your installments come to you. But you cannot control the money that came into the trust. If the trust is only the middle step or any of the sequences fail, the IRS may challenge the deferral. The transaction has to stand up to scrutiny. This is where the experience of the CPA is vital. But the biggest issue is not simply the tax deferral. We need to compare the client's cash needs, the debt, the depreciation, state tax consequences, estate planning goals, fees, and the amount of control you want and the risks you want. You have to run all these paths before signing a binding sale. If you don't, after closing, many of these choices disappear.